This is Jeff Hansen, and this video is about the rotation of asset classes. We seek to avoid major losses. We seek to get out of the stock market when stock prices are at a high point. We seek to get into the stock market when stock prices are at a low point, and then to participate in the stock market's gains. The highs and lows are determined by our proprietary market resilience indexes, and it's through these tools that we identify when to get in and out of the stock market. Industry practice is heavily influenced by modern portfolio theory. There are good reasons for this. This is the thrust of modern portfolio theory. You diversify across stock markets, and for example, you might have 30% of your retirement account allocated to a certain class of stocks, for example, large cap US equities. And stocks have a high trend. They go quite a bit higher over a long period of time compared to bonds, but the variability of returns is quite high. And so if we look at a ratio, in this example, we have a long-term rate of return of 8%, and the variability, which is the standard deviation of weekly returns on an annual basis, the variability might be quite high. This ratio is an easy way to compare different types of investments. Stocks, too, might be more conservative stocks, and the overall appreciation over a long period of time might be lower than stocks 1, but the variability is typically lower as well. So a rate of return might be 6% annualized. The variability might be a 16 percentage point annualized standard deviation of returns. The ratio, the key measure, is 0.38. Stocks 2 has a lower payoff for the variability that you must endure compared to stocks 1. For bonds, we might have an allocation of 40% in our retirement plan, and bonds typically have a lower long-term rate of return, and the variability is lower as well. The correlation to stocks is very low and is sometimes negative. When stocks go down, sometimes bonds go up, and so bonds provide a diversification benefit in that case, and we'll show how that has an impact later on. Bonds might have a long-term rate of return of 4%, a variability of 7%, a ratio of 0.57. If we combine all those into your retirement account, we might get a return series that has a relatively steep slope and the variability is low. And if we just take a simple weighted average of these asset classes and these rates of return, we get 6%. But because these asset classes tend to have a low correlation with one another, the overall variability is lower. And that means that when we combine those, we get a high rate of return for the variability we must endure by selecting assets that are not correlated to each other. And that's a very important point and one of the key benefits of modern portfolio theory. But that's the way it's expected to work, that these asset classes are relatively independent, that what happens in this set of stocks doesn't spill over and influence what's happening in this class of stocks. The reality is that when there's a crisis somewhere in the stock market or somewhere in the global financial system, that shock spreads around the world and affects many different asset classes. And so in this hypothetical example, we have stocks moving higher here, but then quite a bit lower here, abnormally low, as a result of that crisis. And as that crisis spreads to other groups of securities, we see that the normal patterns, historical patterns, are no longer relevant. And the resulting mix can have a very stable pattern in normal times, but in a time of crisis, the correlations break down and the assumptions that the long-term stable returns suggested by modern portfolio theory really don't happen as they should. And so this area, what happens in times of crisis or when there's a big stock market shock, is a key focus of Focus 15 investing. A key point is that correlations of various asset classes move toward one in a crisis. Asset classes that are unrelated in normal times become highly related in a crisis. And investment professionals know this, and they shift their clients' portfolios toward defensive assets, for example, bonds, if they sense a crisis is taking place. At Focus 15, we think it's more reliable to explicitly assess the cycles and when there is likely to be an abnormal decline in prices. Standard industry convention and Focus 15 investing portfolios do asset class rotation to some degree. If we look at the major asset classes of stocks, bonds, and cash, those investment approaches using modern portfolio theory will have relatively stable allocations to stocks, bonds, and cash. Typically 60% in stocks, 40% in bonds, plus or minus 5 percentage points depending on what's happening in the market. The Focus 15 model portfolios combine modern portfolio theory plus loss avoidance. Our model portfolios will have stock allocations ranging from 0 to 100%, bonds 0 to 100%, and cash 0 to 100%. And so compared to the typical approaches in the industry based purely on modern portfolio theory, Focus 15 portfolios will be more aggressive, that is, a higher allocation to stocks in good times for the stock market, and be more conservative in bad times. So we'll hold more bonds or cash if we believe that the stock market is vulnerable to declines.